You bought a policy once. Maybe you didn't call it that. You called it a degree, a certification, a specialty you spent 6 years earning the right to put after your name. But it was a policy, a contract you signed with the future, betting that if you paid your premiums in tuition and time, the future would pay you back in security. Nobody told you the actuarial tables changed. Here's what an insurance company does that most careers don't. It re-underwrites the risk every single year. It checks the data. It adjusts the terms. If the world shifted and the old numbers no longer hold, the policy gets repriced or canceled quietly in fine print nobody reads until the claim gets denied. Your skill set doesn't get that memo. It just sits there aging, assuming the coverage is still active. It isn't. Somewhere in the last 18 months, a clause activated. An exclusion. The exact expertise you were told would protect you, the license, the software certification, the deep technical specialty, has a shelf life now measured not in decades but in product cycles. And the strange part is you can be doing everything right, showing up, staying current in your field, and still be holding a policy that stopped paying out the moment the market's definition of risk moved somewhere else. Think about what happens to a species that specializes too well. The most efficient hunter in a stable ecosystem, the one built perfectly for one prey, one climate, one narrow niche, is also the first to disappear when that environment shifts. Not because it got weaker, because its strength only ever pointed in one direction. The panda ate exactly one plant in exactly one region for so long that its entire body forgot how to process anything else. Meanwhile, the animal everyone dismissed as unremarkable, the one that could eat almost anything, sleep almost anywhere, adjust almost instantly, survives the extinction event nobody saw coming. Evolution doesn't reward mastery, it rewards range. Your career is running the same experiment right now, at a speed no ecosystem in history has ever had to survive. There's a number worth sitting with. Researchers tracking how fast job-relevant skills change have found the gap between fast-moving and slow-moving fields has widened by roughly 3/4 in just the last year. That's not a gradual drift. That's the actuarial table getting rewritten while the policyholder is still asleep, still paying the same premium for coverage that quietly stopped existing. So here's the quiet, uncomfortable math. Every specialized skill you own has something like a half-life, a point at which half its market value has already decayed invisibly before you ever notice the paycheck shrink. Radioactive material announces its decay through instruments. Career decay announces itself through silence. No memo, no performance review flag. Just a slow erosion of leverage that only becomes visible the day you're renegotiating your worth, and discover the number the market has quietly assigned you is lower than the one still sitting in your head. You didn't get worse at your job. The policy just stopped covering the world you're actually living in. Picture the radiologist who spent a decade becoming exceptional at reading a single type of scan. Picture the analyst who became the person everyone called for one specific piece of legacy software. Neither of them did anything wrong. They did exactly what they were told would make them valuable. They went deep, they specialized, they became irreplaceable in one narrow lane. And that's precisely the problem. Irreplaceable in one lane and expendable everywhere else are the same position, viewed from two different angles. Somewhere behind the scenes, something like an underwriting committee is constantly rereading the risk on every specialty in the market, whether anyone can see it happening or not. It doesn't send a letter. It doesn't hold a meeting you're invited to. It simply reprices quarter by quarter based on new information, a new model, a new tool, a new way of doing the thing you spent years learning to do by hand. The professionals who get blindsided aren't the ones who failed to work hard. They're the ones who assumed the terms of their original contract were fixed, when the terms were only ever a snapshot of a moment that has already passed. And this is where most people make the mistake that costs them the most. When a specialist senses the ground shifting, the instinct is to double down, get one more certification, go one layer deeper into the same narrow specialty, buy more of the same coverage that's already failing to pay claims. It feels like diligence. It looks like discipline on a resume. It is actually the insurance equivalent of increasing your premium on a policy the underwriter has already quietly flagged for cancellation. There is a different move, not louder, quieter, and far more durable. It's the shift from owning a single policy to building a reserve, a portfolio of coverage types instead of one deep, brittle specialty. In insurance terms, it's called diversifying risk across uncorrelated events, so no single failure wipes out the whole position. In career terms, it means something specific, skills that don't decay at the same rate because they were never tied to one tool, one platform, one narrow technical moment. The ability to translate complexity into a decision someone else can act on. The ability to learn a new system in weeks instead of years because you've built the underlying muscle of learning itself, not just the content of one subject. The ability to see where value is migrating before the job postings confirm it. These are what some economists have started calling meta skills, and the label matters less than the mechanism underneath it. They function less like a single asset and more like reinsurance, coverage built specifically to absorb the shock when your primary policy fails to pay. You don't build it after the crisis. You build it while the primary policy still looks fine on paper, because that's exactly when the premium is cheapest and almost nobody else in the room is buying it. Here's the part that quietly reorganizes everything if you let it sit for a moment. The people who look the most stable right now, deep specialists in a single, narrow, currently in-demand lane, are often carrying the least diversified risk in the entire room. Their premium looks low because demand happens to be high today. Nobody prices in the exclusion clause until the claim actually gets filed. Meanwhile, the person who looks less impressive on paper, the one who never fully specialized, who kept a foot in 2 or 3 adjacent skills instead of mastering exactly one, is quietly holding the more durable position. Not because they're smarter, because their coverage doesn't depend on one climate staying exactly the same. This isn't a call to abandon expertise. A policy with zero specialization pays out nothing at all. The pure generalist, spread too thin, has no depth. Anyone will pay a premium for either. The people who actually come out ahead in this shift aren't generalists in the shallow sense. They're what you'd call fully covered, deep enough in one area to remain credible, broad enough across several adjacent ones that no single market shift can cancel their entire position in a single quarter. Call it a stacked policy. Primary coverage plus reinsurance plus a reserve nobody sees until the exact moment it's needed. So the real question was never whether your specialty is good. It's whether it's the only policy you're currently holding. Pull out whatever expertise you've spent the most years building and ask what happens to your income the day the market decides that specific risk isn't worth insuring anymore. If the honest answer makes your chest tighten a little, that's not panic. That's the first accurate reading you've gotten on your own exposure in years, and accurate readings are the only kind worth acting on. Notice something else while you're sitting with that number. The exclusion clause rarely arrives with a warning label. It arrives disguised as a slow quarter, a hiring freeze, a role quietly restructured, a client who suddenly doesn't need that specific expertise anymore. By the time it's undeniable, the premium you should have paid 2 years ago is now 10 times more expensive to make up for, because you're rebuilding coverage under pressure instead of by design. Building the reserve doesn't require starting over. It starts with one honest inventory, naming the single skill your income depends on most, and then asking which adjacent capability would still hold value if that skill lost half its worth tomorrow. Not a new career. Just one adjacent policy added deliberately while there's still time to underwrite it on your own terms instead of the market's. The correction isn't dramatic. It's not a new degree, not a full reinvention, not starting over from zero. It's identifying the 2 or 3 adjacent capabilities that would still hold real value even if your primary specialty got repriced to nothing tomorrow, and quietly building coverage there on your own timeline before you're ever forced to file a claim the original policy was never going to pay. Because the goal was never to predict which policy lapses next. Nobody can time that, not reliably, not consistently, and anyone promising otherwise is selling something. The goal was to never depend on just one.